your trading range for the S&P is 3,700 to 4,300. So my bet with Alarian, I win at 36, or no, he wins at 3,600. I win at 4,400. So we could be here forever. According to you, we could be between with that 600-point range. But how long does that last, and how does it resolve itself, above or below those the high and low end of your range?
Yeah. Hi, Joe. Well, I think it's really about inflation. We know the focus is on CPI. People are hoping that it will be 8.1 or lower. But until we have more clarity and know what the Fed intends to do in terms of how many rate hikes over how many periods of meetings they have, it's really a trading range, in our opinion. But that's a pretty broad range. I mean, remember, the market fell 10% from the August 17th highs, and now it was oversold. It's come back about 5.2% just in the last week because we had some decimation. And we had real widespread selling, particularly of technology stocks. And that's when investors started to buy again. And they began to be enthusiastic about prices coming down on things such as, gas. We know gas is down. Hotel airfares are down. There's been other commodity drops, and retailers are selling discounts for a lot of inventory that they've stocked up on. So the numbers should be reasonably good, but it doesn't mean we're out of the woods. And interest rates are going up, and we still have the strong dollar and headwinds in Europe with recession and fuel prices.
Greg, it's interesting just to watch how the market tries to, fool people one way or the other with kind of head fake. So we did have that nice summer rally in July, August from the June lows. Then the pullback, which made everyone say, see, told you, we're going to new lows. And I don't know whether it was just trying to take people with weak hands and say, look, if you're not committed, you're going to feel like we're going to the lows again. You've been committed to a bearish perspective. Are you any more positive at all at this point, given the recent action the past couple of weeks?
Maybe a little bit incrementally, Joe, and that's only because some of the negative catalysts that I expected this year are in fact behind us, and so we are no longer wondering if the Fed is going to raise rates 75 bips or 100 bips. They've been very clear in doing that. Some of the negative revision cycle that I expected is behind us. Even when we look at the third quarter numbers, estimates from the bottoms up at this point are down 5.4% into the quarter, which is twice the normal 10-year average of how much we see revisions in the first 2 months of a quarter. So the street, the analysts, they're all reacting to a better shared reality. That was not the case in January when I said I think the S&P is worth 3,800 because I think earnings are 220 with a 17 times multiple. And so there are more negative catalysts we have yet to encounter, right? And so that rally that you talked about in the middle of the summer was based on an unshared reality that we had reached peak Fed hawkishness, which they clarified after Jackson Hole, and actually were quite clear with us with their plans. They think that it requires a 4% Fed funds rate in order to have any meaningful impact on inflation. And I think that this number will show us exactly that. Despite maybe 50 basis points on the overall, which you could argue energy is affected by vectors outside of our economy. And in fact, you could argue that maybe even lowering the strategic reserve had an effect on that, particularly as we go to enter the winter heating months. Core will be the same, driven largely by the housing component, but we'll see little impact on core to date. We've seen little impact on the job market to date, which gives them the breathing room to become more aggressive and get to that 4%. And so I think despite Wall Street reacting favorably to this, there's very little to show thus far that Fed action has had a meaningful impact.
All right, we're going to have a big housing discussion in a little while. There may be some glimmers there. I don't know, Greg. It's morning in America. That's as positive as you've been in a while. I'm taking this as a major, as a big day, a red letter day. So,
right.
To me, it doesn't sound like you think we're going to new lows, Greg.
We will retest those June lows. Absolutely.
We'll retest them.
We will retest those June lows. Okay. At the end of the day, I'm not sure everyone has gotten the message that there is more behind the 75 we're going to see in September. I'm not sure everyone understands yet that the 60 dollars of earnings for the fourth quarter in the S&P is too high, and that needs to come down fairly dramatically. So we'll retest those, but then we'll start to look at 2023, where we probably have mid-single-digit earnings growth on the S&P, not the numbers that we see today, probably mid-singles off of 220, putting us at 230. And so you put 17 times on that 230, and for right now, for next year, I'm looking at about 4,000. Well, that's about where we are now.
Right.
And so, if what you're saying is that I'm not at 4,700 predicting 3,800, then yes, I'm incrementally more positive.
Okay.